Welcome to Module 1, Unit 3. In the previous unit, we talked about risk management, and then in Unit 1, we mentioned the diffusion of innovations. In the diffusion of innovations, we talked about the different stages of adoption of successful innovations, and we're going to explore how we manage those different stages. But it's important to remember that this S-curve from Everett Rogers' work on diffusion of innovations is talking about successful innovations. And most innovations are not successful. So it's important to bear in mind that most ideas are bad ideas and they fail. So there's actually several stages to this adoption process, and they have different risks, and we have to manage those risks differently. In the lean startup literature, two key transitions are discussed. The first transition is about problem-solution fit. So in the very initial stage of innovating, we have to start by finding a problem that our users will actually pay us to solve. So the first kind of risk management activity you're going to do is finding out if we have a problem that's worth solving. And there's a bunch of things we can do to investigate that. Once we've discovered that we do have a problem worth solving and that people will pay us to solve it, we have to find a business model that will work. And that's a very different problem, a very different kind of problem. And once we've actually found a business model that works, that will sustain our business, we have what's called product market fit. So once you've found problem solution fit, you have a problem worth solving, then you have to find a business model that will work, that will allow you to keep running your business, and once you have that working business model, to scale that business and scale the adoption of your solution. So these are two key phases in the product lifecycle. Each of these stages in the product lifecycle has different risks, and you have to manage those differently. I'm just going to look at two particular kinds of activity. These aren't the only two kinds of activity that we do in the product lifecycle, but they illustrate the different kinds of risks and the different kinds of management strategy we will need based on product lifecycle stage. So one of those stages is explore. That's when we're doing radical or disruptive innovation. We're coming up with new business models. For that kind of activity, it's really important to have a small cross-functional, multi-skilled team, simply because the rate at which you're moving is so fast that you need to be able to have all those people on one team, talking to each other, problem solving together. That culture is very different. You're going to fail a lot. You're going to have to try out lots of different things. So the culture is all about risk tolerance for failure and learning as rapidly as possible. Your biggest risk is that you're not going to achieve product market fit, or if you're earlier on in the life cycle, even problem solution fit. And your goals are going to be, in the case of product market fit, creating new markets, discovering new opportunities within existing markets. And your measure of progress, if you're pursuing product market fit, is going to be, do we have a business model that works? Once you're much further up the adoption curve, you have an innovation which is proven, you have a business model that works, you've scaled your business, you're going to be doing something very different. So this particular phase of the adoption curve we're going to call exploit. And as I say, these aren't the only two phases. They just illustrate how in different phases you're going to think about things differently. In this exploit phase, we're doing incremental innovation. We have an existing business model, but we're trying to optimize it. We're trying to reduce costs. We're trying to increase conversion. And we're typically going to have a much bigger team, and you're going to have to manage a much bigger team using the principle of mission, which we'll talk about later on in the class. The culture is going to be very different. It's not about taking crazy risks. It's about incrementally improving and optimizing. We're going to have different things that we measure. We're going to measure things like customer satisfaction and our ability to achieve our targets and milestones. Our goals are going to be different. We're going to have a focus on outperforming our competitors, on maximizing our yield. And our risk management approach is going to be very different too. We're going to have a different series of trade-offs that we're going to make. So the point of this is, based on where you are in the adoption curve, all kinds of things change, from how you organize your team, to the culture you try and create, to your strategy, to your goals, to how you measure progress. So that's very important to bear in mind as a product manager. you've got to think about the kinds of risks that you have to focus on, and it's going to be based on where you are in the life cycle, as well as the kind of markets you're pursuing, whether it's B2B, B2C, the kind of product that you're building, and what your customers are like and the kind of things your customers value. So all things to bear in mind. Many of you will end up working in large companies, and large companies do not have just one product. They typically have many different products, and those products will be in different phases of their life cycle. And that presents a problem known as portfolio management. In portfolio management, you have a portfolio of different products which may be in different stages of their life cycle. How do you do portfolio management? Well, portfolio management is a whole field in its own right, and we're not going to cover that in a great deal of detail, but it is important to talk about here because portfolio management has, or product life cycle has a big impact on how you think about portfolio management. So these three people, Bagai, Kohli and White, wrote a small book called The Alchemy of Growth, where they talk about what's called the 3 horizons model. And in this model, they basically separate out products based on life cycle into 3 different portfolios. One is your current businesses. Those are the mature businesses that are well up the adoption curve, that are generating a lot of your cash flow for your business today. Those are the businesses that are, in the 0 to 12 month horizon in terms of generating cash flow. Then you have some more speculative businesses that are further down the adoption curve, that have potential to create large amounts of cash flow, but now are in the growth stage. So those are making money, but they're going to create substantial cash flow in the future, we hope, if they continue to grow. And they need to be managed differently. And then there's Horizon 3, which is your innovations, your startup ideas, your new product ideas, your new product category ideas, your new business model ideas. And they have to be managed very differently. And the point of this 3 horizon model is that as a big company, you can't just focus on the businesses that are making money today. You have to have options for future growth, because eventually your existing high cash flow businesses will become commoditized and they will no longer make substantial money for you. So as a big business, you have to have products in each of these different horizons. And as I said earlier, they are managed very differently. So this 3 horizons model is used broadly at a lot of different companies. One example is Intuit, and Intuit have talked about how they manage these 3 different horizons. They talk about their existing businesses, which are things like TurboTax and Mint, where those are mature businesses, they're mature products, they're widely adopted, and they're focusing on growing the category, they're focusing on market share, they're focusing on net promoter score for their customers, and of course revenue. And they will tend to invest about 60% of their money in those existing businesses. Then in Horizon 2, they have a whole bunch of adolescent businesses where they're focusing on growth and increasing efficiency. They might not be profitable yet, but they're continuing to grow very rapidly. Things like QuickBooks Online Accounting. And they'll typically invest 30% of their money in growing those businesses. And then they spend 10% of their operating expenses on a whole bunch of very speculative products that are new ideas, new innovations, don't potentially have proven business models yet. And what they focus on here is what they call love metrics, which is, do customers love them? Do they use them actively? Do they talk about these products using word of mouth? Is there viral spreads of these products? So one example of that was SnapTax, which let you take a picture of your documents and then create a very simple tax return. And they typically spend 10% of their operating expenses on these growth ideas. Now, you cannot predict the future. You cannot know which of your growth ideas is going to be profitable. So given that you can't predict which of those ideas will be a good idea, what you have to do is use a very old idea called optionality. So optionality is how you manage that part of your portfolio of very new ideas where you have no idea if those ideas will succeed or not. This is how venture capitalists manage their portfolio. What they do is they have funding rounds where they raise a large amount of cash from their investment partners, and they invest it in a number of different businesses. And they expect that most of those businesses will fail, but a small number, maybe one or two from a round of 10 to 30 businesses, will succeed spectacularly and have an enormous upside. So this idea is also how investment funds work. You don't invest in just one, or index funds for that matter. You don't invest in just one company, you invest in a wide range of companies across a bunch of different sectors in the hope that if one sector does badly, other sectors will compensate for that. So this is a very well understood model of investment, and the idea is, because we can't predict which businesses will be successful, we invest in a large number of them, but we limit our downside. So we say we're going to invest this much money. If it doesn't work out, we're not going to continue to invest. This is your runway, and once that money is over, we're done. And we expect that most of those businesses will fail and that some will have a substantial positive upside. So that's how we can think about investing in small businesses. Very different from how we invest in Horizon 2 or Horizon 1 businesses. And that's just a picture of how we manage risk differently based on where our products are in that adoption life cycle.